Hello, my name is Stefan van Woenzel and I am the author of the book called Oil Traders' Words. Oil Traders' Words is a book that consists of about 2,500 oil definitions that are used in the daily talk of the oil trader and the logistic people, the operator, the broker, etc. etc. Everybody in the oil business is always using a lot of technical words, and a lot of people have actually no clue what they mean. They're just talking with the business like it is just common, and we don't ask too many questions on what it means and how to work with it. So, Oil Traders' Words, it's a book available on Amazon.com or any other online bookshop. So I would recommend it to buy it when you are working in the commercial side of the business. So just as an example, one word, what I explain, one out of many, is technical trading. So what is it actually, technical trading? Technical trading is actually a matter of just looking at the charts of the oil prices. How are they going? How are they going up? How are they going down? How are they going on a daily basis? And what kind of signals can we see? The most famous is, of course, the trends. I mean, there's an uptrend, downtrend. But when you see the prices steadily going up over a long time, then we have an uptrend. So then you trade basically with the trends. But in the lines, you can see how, if there's any signals, if the price is going up. There is this ABC, Elliott, Fibonacci. There is dodges, morning stars. There's many signals that people can look at them. And if you know what those signals are and if you know how it works, then you can trade on it. And you don't have to look at the fundamentals because you have to believe in the technicals. And the beauty of the whole thing is that so many people are working in the paper business, the futures of crude oil, that everybody is trained to look at technicals. A lot of people are only trading on the technicals, and because everybody sees a certain signal, they say, "Oh, now it's a signal that the price is going up, so we need to buy." And because everybody sees it and everybody is going to buy, it's going to work. So simple it is. I mean, it's just like the whole market has been trained and has been learned to respond on the signals in the same way. And that is why it works. So when you see in Fibonacci, price is going up, going down, going up, going down, and you see that trend, and everybody agrees with it, and everybody starts buying when the signal is going up, prices will go up until a certain roof, then everybody says, this is the roof of the Fibonacci, then we're gonna sell again, and everybody does it until it finds an underline, and that's how it works. It's actually kind of psychological thing in the market. But of course, I mean, it's always surprises against technical trading. That is, of course, a little bit of the fundamentals, the things that happens in the business, in the real life, that can influence, that can have an impact on the price. Just as a simple example, in 2008, at a certain moment, prices were $95. And then it went up. It went into uptrend. It went up from 95 to 107, 107 to 100, 100 to 117, 117 to back to 110, 127, 120, 137, 130, 147, 140. Then it's supposed to go back up to 140, 157. But what happened there? That was that the fundamental came in. There was a fundamental thing happening in the market that forced prices to go down. And the uptrend, that was a typical Fibonacci. I mean, those who have been able to see that kind of technical signals and the technical trend, they have been able to make a lot of money. But the market was very volatile in those days. I mean, if I talk about from 110 to 117 and then back down and down to 110 and 127, and I mean, you can imagine that there's a lot of risk as well. So you have to be careful always. But that was a Fibonacci. But the reason why the price actually went down, in my view, of course, is that you saw in the US the housing market going down, banks getting into problems, and as a result, the banks needed money, and they were pulling out of the futures market, of the trading market. The funds needed money; they went out of the trading market. And when people are leaving the paper market and they start sell out their position, then it's getting less and less and less on the price. It went down to 140, 139, 138. And then, of course, the trading houses, they have their controllers and pointing on the stop loss rule, where people have to get rid of their positions just to be sure that they're not going to lose more money, cut the losses. And when everybody starts cutting the losses, then you get just a total crash. And that is very black-white, but that is a bit the way how it collapsed in 2008. And now we are down, and economy is going back up again. So I think that the technical trading getting stronger again, because when economy goes up, there will be more participants in the paper market, and that will be more technical people. So the technical thing might get stronger. Well, then you know a little bit about technical trading. It's not a lesson about how to trade technical, but it's just showing a little bit how important it is and how it works. So that is one of the many words of the things I explain in the book, Oil Traders Words. But go to Amazon, go to Google, Google Oil Traders Words, and you will find maybe my website or other websites where you can buy it. But it's for sure on Amazon also as ebook. 2,500 definitions, a lot of trading phrases, calculation tables. It's physical, technical trading, it's refining, logistics, HSE, everything is in it. So good luck and make a right choice and just get the book on your desk. I think it's smart to have. Okay, cheers, bye.